If you are a pensioner living in the United Kingdom, you need to stop what you are doing and check your bank balance immediately because a sweeping set of new financial regulations has just taken effect that could change how you access and protect your money forever. As we move through April 2026, millions of older adults are finding themselves at the center of a massive regulatory overhaul, often referred to in hushed tones as the 250-pound rule. While the headlines might sound like your bank is suddenly limiting your freedom, the reality is a complex mix of new fraud triggers, mandatory reimbursement caps, and even new government monitoring powers that every retiree must understand to avoid having their accounts frozen or their benefits questioned. This is not just a minor update to the fine print of your banking terms and conditions. It is a fundamental shift in the social contract between the British state, the high street banks, and the silver generation. The core of the confusion surrounds the so-called 250-pound rule, which has become a significant internal threshold for major lenders like Barclays, Lloyds, and NatWest. There have been frantic rumors circulating that pensioners are being blocked from withdrawing more than 250 pounds of their own cash, but let us be very clear, there is no law preventing you from spending your money. However, what has changed is the implementation of new soft triggers under the 2026 Consumer Duty Guidelines. Now, if you attempt a digital transfer or a large payment to a new recipient that exceeds 250 pounds, your bank security system is likely to pause the transaction. This is a mandatory safety check designed to combat authorized push payment fraud, which has become the most prolific financial scam in the country. For a pensioner, this means that a simple payment for a new sofa or a gift to a grandchild could suddenly be flagged, requiring you to navigate a series of security questions or wait for a verification call before the funds are released. What makes the April 2026 period so critical is the official shift in how fraud victims are treated by the law. For years, the banking industry operated under a voluntary code, but as of now, the payment systems regulator has enforced a mandatory reimbursement scheme with a much lower ceiling than many expected. While early proposals suggested a safety net of nearly £500,000, the final 2026 limit has been set at £85,000. This means that if you fall victim to a high-value investment scam or a complex romance fraud and lose more than £85,000, your bank is no longer legally obligated to pay back the full amount. Furthermore, banks are now permitted to charge a £100 excess fee for every fraud claim they process. There is, however, a vital exception that every viewer must know. If you are considered a vulnerable customer, which includes many people over the age of 67 or those with health conditions, the bank is strictly forbidden from charging you this £100 fee. You must ensure you are registered correctly with your bank to benefit from this protection. But the changes do not stop at fraud protection. They extend into the very privacy of your financial life. Under the new Public Authorities Fraud, Error, and Recovery Act 2025, which has seen its full implementation in early 2026, the Department for Work and Pensions now has unprecedented powers to verify the eligibility of those receiving means-tested benefits. If you are a pensioner claiming pension credit, your bank is now required to flag your account to the DWP if your balance consistently exceeds the £16,000 capital limit, or if there are signs that you have been out of the country for longer than the permitted 4-week window. While the government insists this is not a snooping power and that they cannot see your individual grocery receipts, the automated flagging system means that thousands of retirees could face benefit reviews or even suspensions if their savings accounts show unexpected growth. This is a massive shift in how the state monitors the elderly, and it makes the April 8th administrative rollover a nervous time for anyone who hasn't kept their declarations up to date. For those who prefer to deal in physical currency, the 2026 landscape is equally transformed. As bank branches continue to vanish from our high streets at an alarming rate, the government has introduced the Reasonable Access to Cash regulation. This April marks the first time that banks can be fined by the Financial Conduct Authority if they close a branch without providing a suitable alternative, such as a shared banking hub. By the start of 2026, over 225 of these hubs are now active across the UK, acting as neutral zones where you can meet a community banker from your own specific firm. However, even at these hubs, the 2026 Consumer Understanding requirement means that staff are now trained to respectfully intervene if an older customer attempts to withdraw an unusually large amount of cash. If you walk into a hub and ask for £5,000 in notes to pay a tradesman, you should expect a private interview where the staff will check that you aren't being pressured or coached by a rogue trader waiting outside. The psychological impact of these changes is profound. For a generation that grew up with the privacy of a passbook and the local knowledge of a friendly bank manager, the shift to AI-driven triggers and government data sharing can feel like an invasion. The £250 threshold is seen by many as a loss of autonomy, a sign that the state no longer trusts the elderly to manage their own affairs. Yet, the banks argue that with over £6 billion lost to fraud and error every year, these friction points are the only way to protect life savings. This tension is at the heart of the 2026 banking update. It is a world where safety comes at the cost of speed, and where your bank account is no longer a private vault, but a monitored portal. So, what exactly should you do to protect yourself and your money as we move past the April deadline? First, you must contact your bank and ask for a vulnerability assessment. This sounds clinical, but it is actually your greatest shield. By officially recording any difficulties you have with technology or any health issues, you ensure that the bank has a higher standard of caution when handling your accounts, and that you are exempt from the new fraud claim fees. Second, if you are a pension credit claimant, you must ensure that your savings are below the £10,000 mark for full benefits, and certainly below the £16,000 absolute limit. The new automated checks between banks and the DWP mean that forgetting about an old ISA or a dormant savings account is no longer an option. The system will find it. Third, you must embrace the new communication protocols. If you are making a large purchase over £250, do not wait for the bank to block it. Call them in advance and tell them exactly what you are doing. This pre-clearance is the only way to navigate the new 2026 triggers without the frustration of being declined at the till. Finally, make use of the new banking hubs. These are your new high street branches, and the staff there are specifically tasked with helping older customers transition to this new era of digital-first banking. The landscape of British finance is changing, and while the technology might be getting more complex, the goal remains the same: ensuring that the money you worked for throughout your life stays in your pocket and out of the hands of criminals. The significance of the £85,000 reimbursement cap cannot be overstated. For many pensioners who have sold a family home or inherited a large sum, their bank balance may temporarily exceed this amount. In the past, there was a sense that the bank would always make it right if a fraudster got into the system. But in 2026, that safety net has a hard floor. If you are holding more than £85,000 in a single account, you are effectively self-insuring any amount above that limit against the risk of sophisticated fraud. Financial advisors are now suggesting that retirees spread their wealth across multiple banking groups to ensure that every penny falls under the mandatory reimbursement protection. This is a logistical headache that many did not expect to face in their retirement, but it is a necessary step in an era where scammers can spoof phone numbers and use artificial intelligence to mimic the voices of loved ones. Furthermore, the role of the post office has been elevated to that of a critical service provider. From April 2026, post offices have been granted the same legal standing as bank branches for the purposes of cash access. This means that your local sub-postmaster is now your frontline banker. However, they are also bound by the same 2026 reporting rules. If you frequent the post office to manage your pension, be prepared for the same questions regarding large withdrawals and the same digital triggers for transfers. The integration of the post office into the national banking grid is a double-edged sword. It provides local access, but it also ensures that the security friction is universal. No matter where you go in the UK, the £250 trigger and the £85,000 cap are now the law of the land. The DWP's new powers have also sparked a renewed debate about the gray economy. For years, many pensioners have supplemented their income with small cash gifts from family or minor sales of personal items. In the era of manual reviews, these went unnoticed. But the 2026 data matching systems are designed to look for lifestyle inconsistencies. If a pensioner's bank account shows regular, unexplained deposits while they are claiming the full rate of pension credit, the algorithms will flag this as potential undeclared income. While the government claims they are only looking for large-scale fraud, the reality is that the margin for error has disappeared. For the honest pensioner, the advice is simple. Keep receipts for everything, and be prepared to explain any large movement of money. The transparency required in 2026 is unlike anything we have seen before in the British welfare state. As we look toward the rest of the decade, it is clear that the banking system will only become more automated. The 2026 rules are a pilot for a future where every transaction is evaluated by an algorithm before it is approved. While this might stop the majority of scams, it also places a burden on the elderly to remain digitally active. For those who refuse to use a smartphone or the internet, the world is becoming smaller and more difficult to navigate. This is why the fight for banking hubs and reasonable access to cash is so vital. It is about more than just money. It is about the right to participate in society on your own terms. The April 8th deadline is a reminder that the world is moving fast, and as a pensioner, you must be your own best advocate. In conclusion, the UK banking rule change of 2026 is a monumental shift that requires every pensioner to be proactive. Do not wait for your card to be declined or for a letter from the DWP to arrive. Take control of your status today. Verify your contact details, register your vulnerability if appropriate, and understand the limits of the new reimbursement schemes. The £250 rule might be a point of friction, but it is also a sign that the system is trying, however clumsily, to adapt to a dangerous new world of financial crime. By staying informed and using the tools available, from banking hubs to pre-clearance calls, you can ensure that your retirement is defined by security and peace of mind, rather than by the stress of shifting regulations. The significance of the April deadline also ripples through the wider economy. As the state pension age officially rises to 67 for many during this period, the pressure on personal finances is higher than ever. To manage this, the government is focusing on reclaiming lost funds from fraud and error to keep the system afloat. This is why the £85,000 limit was chosen. It covers the vast majority of people while limiting the liability of the financial sector. For the individual, this means the golden age of banking, where every mistake was forgiven, is over. We are moving into an era of shared responsibility, where you are expected to follow every bank warning or risk losing your right to reimbursement. The rise of banking hubs represents a compromise between the old world and the new. These hubs, staffed by community bankers, are designed to offer a human face in a digital world. If you are confused by the £250 rule, these bankers are there to walk you through it. They can help you set up trusted beneficiaries so that your regular payments to family are never blocked. This is a crucial step for any pensioner in 2026. Don't wait for a block to happen. Sit down with a community banker and whitelist the people you send money to most often. This simple act of preparation can save you hours of frustration later. As we look toward the middle of the year, we expect the Financial Conduct Authority to release its first report on how these new friction points are performing. Early data suggests that while fraud losses are starting to dip, customer satisfaction among the over 70s is also falling due to the increased difficulty of moving money. This tension will likely lead to further adjustments in 2027, but for now, the rules are set. The £250 trigger is here to stay, and the £85,000 cap is the new ceiling for your safety net. By keeping your information current and your communication channels open, you can master this new system and ensure your financial independence is never compromised. Finally, remember that the bank will never ask you to move money to a safe account. This is the #1 scam targeting pensioners in 2026. No matter what a caller says, no matter how much they mention the new 250-pound rule or the DWP checks, your bank will never pressure you to transfer your savings. If you receive such a call, hang up immediately and use a different phone line to call your bank or visit your nearest banking hub. The tools of protection are only effective if we use them wisely. Stay sharp, stay informed, and make the most of the protections available to you in this new era of British banking. The journey through the 2026 financial landscape has just begun, and the best way to travel is with your eyes wide open. This entire situation is compounded by the fact that the state pension itself is rising by 4.8% this April, bringing the full new state pension to approximately £241.30 per week. While this increase is welcome, it pushes more pensioners closer to the income tax threshold, especially if they have small private pensions. This makes the accuracy of your banking records even more critical, as HMRC and the DWP are now sharing more data than ever before. Your bank account is essentially the digital diary of your life that the government is increasingly interested in reading. By keeping your records clean and being aware of these new triggers, you protect not just your cash, but your reputation with the state. The landscape of 2026 is one of significant change, but it is also one of opportunity for those who are prepared. For the first time, the law explicitly recognizes the need to protect cash access and to treat vulnerable customers with additional care. While the triggers and monitoring might feel intrusive, they are the response to a world where fraud has become a multi-billion-pound industry. By understanding the £85,000 limit and the £250 soft trigger, you are placing yourself in a position of strength. You are no longer a passive observer of your finances. You are an informed participant who knows exactly how the system works. As you move forward through 2026, keep these rules in mind, use the resources available, and never be afraid to ask your bank for the help you are legally entitled to receive. The future of banking is here, and with the right approach, you can make it work for you. Stay alert, stay secure, and keep your hard-earned pensions safe from the challenges of the modern world. In many ways, the 2026 banking update is a test of the resilience of the British pensioner. It is a group that has lived through countless economic cycles and technological revolutions, and this is simply the next chapter. The key is to refuse to be intimidated by the new jargon or the digital hurdles. Whether it is the 250-pound rule or the DWP's new data matching powers, these are systems that can be navigated with patience and the right information. As the banks and the government move toward full implementation this April, your best defense is to be the most informed person in the room. Check your balances, verify your eligibility for pension credit, and make sure your bank knows who you are. With those 3 steps, you can face the financial changes of 2026 with the confidence and dignity you have earned. One final reminder: the administrative rollover for many of these checks is April 8th. This is the date when many internal bank systems will sync their new fraud models, and when the DWP's first major batch of automated checks is expected to begin. If you have been meaning to update your savings declaration or change your phone number on your bank account, do it before the 8th. This will ensure that your records are accurate when the new systems go live, minimizing the risk of a false positive flag on your account. The 2026 transition is a massive logistical undertaking, and being ahead of the curve is the best way to avoid being caught in the gears. Stay safe, stay mobile, and stay financially secure. The future is coming, but you are ready for it.